All right. I think we're there. Got wait for a few more people to join. All right. Thank you, everyone, for joining. We are going to start the session now, and thank you for your patience. We will get this going now and underway. And those who've joined, thank you so much for joining tonight. I will get this rolling for you now. Okay, so tonight we are talking about show me the money. And the reason I've really picked up this topic to stream today is because a lot of people have gone through a lot over COVID and, of course, the high interest rate market that we've seen over the last few years. And that has actually posed a lot of challenge for people to not only on the cash flow, but also the way they live and the way they are spending their money. There's obviously a lot of problem for people to be able to hold their properties and have to change their lifestyle to make things work. So just after COVID, whilst interest rates were going up, we saw that as a big challenge in the market, and we also saw a lot of people could not borrow money either. So we ventured into trying to see, okay, we should try to look at some different creative strategies that we have done even previously and see if we could buy properties for clients that would actually give them cash flow today, not after 5 years, 10 years, once their loan comes down or the rent goes up. So we've been quite successful in enabling certain strategies that have enabled cash flow for clients from the very first get go on settlement. And today we want to walk you through those strategies and also show you how to make that money today in today's market. Now, the good news is the market's working in our favor. Interest rates are coming down, so we've had that interest rate cut last month as well, for the very second time this year, and that's really good news. Hopefully, we'll have another couple of rate cuts in the coming 6 months, and that will actually help all of us to be able to borrow more money, um, alleviate some of the problems we've seen with holding properties. Cash flow will become a little more easier. But on top of that, as those things will happen, you are before getting into the situation where we again tighten your lending and you get to a point where you can't borrow again. These strategies we're going to talk today will help you balance your portfolio with your negatively geared properties that we are all holding today. And that is important because that allows you to keep borrowing money against what you want to do. So, without any further ado, I will start this now and show you some strategies of what we can do. I do need to talk about where we are, who we are. So give me a second. So we have a legal disclaimer. So Find My Real Estate is a buyer's agency, and all its associated entities take no responsibility, and we disclaim against all liabilities for any loss, damages, or cost as a result of using information today. Whatever is being presented is in general nature only. This is not an advice. So please seek your own independent legal, financial, and investment advice if you're looking to do so. And past performance may not be indicative of future results. So it is important that we put this up there. Whatever you see tonight are real examples. We've actually achieved some of those results as well. And we want to show you how you could do that. But today, this is not about advice. This is just sharing the information so you can absorb it. If you have questions, you can ask. And the whole idea is to educate today people who are listening to this. What we do really matters because this is not simple to actually build a portfolio for a lot of people. We're trying to make things a lot more easier for people to see what their goals are and how do we actually get get them to those goals using property as a vehicle. So before we get started, I just want to talk about my journey. Those who don't know about me. So I am Anubhav, founder and director of Find My Real Estate. And I started this business 6.5 years ago in 2019, just before COVID. But prior to that, I've been 21 years in Melbourne. I've done my master's here in engineering and 13 years of corporate life that I've actually thoroughly enjoyed and made really great friends and a huge network. Along the way, I've also had a great property journey as well. I lost money at the beginning when I came in this country 22 years ago, but then after that, I learned the right way how to invest, and then I learned how 1% investors are actually investing money in this country, and that actually really helped me change my outlook. And with that, when I started to build my portfolio the right way, I learned how you could actually balance your portfolio the right way by buying the right structures, but also at the same time the strategies that properties allow you to get into, which most people don't know about that. So then I decided that whilst I was at the peak of my career, I decided that I want to do something different. I wanted more freedom for myself. So I took the plunge of jumping into a buyer's agency and really use my knowledge experience to be able to help consult and really find the right solutions for the buyers. And tonight you're going to see just some of the creative strategies we have implemented for clients and how that can actually help you, which are quite relevant to today's market as well. So, with that, our mission has always been to help Australians achieve early modern retirement, giving them the lifestyle to retire. I always say, why do you have to retire when you're in 60 or 70s? Why can't that happen in their 40s and 50s? So, it's all about trying to get that done earlier. And I will show you some things that you can actually see how you could achieve that early modern retirement for yourself. These are just some of the examples to show you that we are seeing what we are seeing and the results we have recently achieved after COVID in these last 2 or 3 years by investing in the right place at the right time. And it's quite clear that the recent results are showing that 58% growth in 14 months, 23% growth in 18 months, 33% growth in 14 months. I'm sure everybody would want this type of results. They do look quite unrealistic because it is people who live in Victoria, for example, have not seen this type of growth in the last 3 years at all. In fact, the needle has not moved at all. So it almost feels very unrealistic. But these are actual results of clients who have achieved this type of growth. They've taken equities out to build further portfolio, and it's all about timing. So I'm going to show you where we are per state as well right now, and where might be the right opportunities to invest. Before we also talk about, of course, the main topic being show me the money, and we're going to talk about strategies how that money comes through. But this is quite important because ultimately it is the growth that you really need in the years when you're building the portfolio. But to balance that and continue to keep building portfolio, you also need cash flow, which is the topic today. So, talking about the markets, this is where we are as of the 31st of May. And you can see Sydney, Melbourne, Brisbane, Adelaide, Perth, Hobart, Darwin, and Canberra there. The median price point at the state level. So we've got Sydney obviously topping the chart, which is always the case. Melbourne has always been the second, but what has Melbourne has had a decline in growth whilst others have grown. So when I say decline in growth, many areas are still quite negative, but outer areas of Melbourne has held their values, so they've been pretty flat. But there is really no growth in Melbourne. And in the last 3 years, Brisbane, Adelaide, and Perth have really gone up crazy. And that's why the results that you saw earlier, where my clients have actually made 30, 40, 50% growth in short 18 months, 20 months, 24 months, that's very real because we've actually invested in Brisbane, Adelaide, and Perth or regional areas of these states. And that has really given that growth. So, where do we invest now? Um, I guess considering the changes that we have seen, federal elections are now over. So we do believe that it's time for Melbourne to rise. Melbourne cannot sit on number six in the median price across the country. Definitely seeing right now Melbourne pick up. We are quite active in Melbourne market right now for the last 6 months. And what we have seen is the shift in the temperature. The heat is starting to pick up in regional markets at least. Some of the regional markets right now, we are seeing 10, 15, 20 offers on a single property as well in Victoria. And that is absolutely great news because what will start to happen is it will start to spread as interest rates come down. It is going to only get more better, which means metros and majority of the suburbs will see that rise as well as people's sentiments will change and it's all going to go in the right direction. Few more rate cuts and you will see this happening everywhere in Melbourne. So it is the timing that we're talking here. And again, this is not an advice. Based on how market cycles have moved previously and how we've timed the market, we do believe that Victoria is now well positioned with the right population, with the right dynamics for it to really grow. And even investments, when you do the numbers and you look at how Victoria is really comparing as compared to other states, if I'm talking regional, the numbers absolutely stack up. If you buy a $500,000 property, for example, today in South Australia or Queensland, or even for that matter in Victoria, and let's say you're getting a rent of $450 to $500 per week on that, your negative position or negatively geared position on all three states for the same price point with the same amount of lending, with the same interest rate, when we actually do the numbers, it's almost comparable. So, and that's the bottom number that actually matters when it comes to negative cash flow or negatively geared. How much negatively geared are you? 3 years ago, situation was different because price points in Brisbane, Adelaide, Perth were really low at that point in time. You could invest in 300K type properties, as I showed you earlier, where the 30, 40, 50% growth has happened. And Melbourne, you were still buying properties for 500, 600K. It didn't make sense to invest in Melbourne when a lot has changed. And of course, it was not with land tax changes and other changes that came in on the rental side as well. It was not very conducive to buy an investment in Victoria. So a lot of people invested in other states. And now those states, as you can see on the chart, Brisbane, Adelaide, Perth have really gone up. What that meant is now Melbourne's lagging behind. And as a result, the investment now in Melbourne makes a lot more sense because it is more affordable now in regional markets or Melbourne as compared to other capital cities or their regional counterparts. And that's why we believe that when you talk affordability and with market sentiments, we do believe that Melbourne is going to show signs very quickly. And that's what we mean by when we are talking about if we have to get someone from on a retirement path or help them retire quickly, not in their 60s or 70s, but in their 30s, maybe in their 40s or 50s or late 40s or late 50s, then most people are okay with this 150K passive income to actually build that for themselves based on numerous conversations we've had over the last 6.5 years in the business. Most people are very comfortable with 100, 120, 150K passive income. So how do we actually get that 100, 150K passive income? What does a portfolio look like to be able to do that? I've shown you some of the properties that have grown. So if you time it the right way, you can build equity really quickly. But what you need is cash flow on the side. And that's really the topic today. Show me the money. And that's exactly where we, sorry, just give me one second. Get my voice back as well. Sorry for the interruption. Okay. So I can still hear myself. All right. Okay. Okay. I think I can hear still myself for some reason. Just one second. Are you guys able to hear? If you can put in the chat. Okay, just give me one second. Sorry for the interruption. Okay. Right. I think it's okay now. It's working now. Okay. Yep. Okay. Finally, IT. Okay. Okay. I can now. I then now there's no echo, so that's good. Right. So I was talking about strategies that I think even the sharing is probably not working. Somebody is saying sharing is not working. Can others see us properly? Okay, or not? Okay, let me share my screen again. Just 1 second. Right. Can you see my screen now? Okay, 1 second. I think there is a problem. Okay, I think maybe it's going right. So let's get going. Okay, so let's get this underway now. So apologies. I think we've had some issues on my end. Okay, Rakesh can see as well. Thank you very much, Rakesh, for confirming. Give me 1 second. All right. So what we are saying here is if we actually look at the cash flow strategies, there are so many cash flow strategies that you can see: regional, commercial, rooming house. And today we're going to talk about that one. NDIS, we're not very sure. A lot of people have invested in NDIS. It's something that I personally don't like. Then you've got short stay, which is Airbnb, dual occupancies, granny flats, lease, sublease options, business real estate. So tonight we are going to focus on rooming house. We're going to focus on short stay Airbnb, and of course, the main one being commercial. So these are the three ones that we do believe that are you can balance the risk if you are doing the right thing in the right way and you know what you're doing. But I'm going to talk about that. We're going to introduce these topics to you today, and you'll be able to see that for yourself. So now I'm going to actually try show you exactly the first strategy, which is for us is the rooming house. Just going and what does a rooming house really mean? It's basically a house that's to be built as class 1B classification. Everyone, you and I, we all live in class 1A, and class 1B is a different type of classification. So the property needs some modification to be deemed as class 1B. It's a maximum 300 square meter house with you can have up to 12 occupants in that property. So if you look at the layout on the right hand side, that's an 8 bedroom property, and there are two bathrooms in that property. So originally there were not 8 bedroom. Sorry, originally there were eight. There weren't any 8 bedrooms. It was a standard 3 or 4 bedroom property, and that's been converted into 8 bedrooms. So this is an existing house that's been turned into a rooming house. So from 3 or 4 bedroom to 8 bedrooms, and possibly an added bathroom as well. So this property means that you have turned a standard property into a rooming house, which again, you need to make sure that it meets the code and it needs to be class 1B classification. So those changes need to be made. You can also build brand new class 1B rooming house. And you can, in Victoria, for example, you can go up to 9 bedroom, 9 bathroom. So each occupant can actually have their own private bathroom, a small courtyard, but they're individually private. But again, they've got common areas to share, which could be the hallway, it could be the living area, it could also be your kitchen, dining area, or it could be a common courtyard as well. That might be there in any property, which will allow them to be able to share those common areas amongst themselves. Now, rooming houses generally think of it like a hotel, like it's a mini hotel where everything is there for you. You just pack up your bags and you can come and live in that house. So that's really where it is suitable for people who are single, retirees, students, divorcees, couples. And the facilities are pretty shared, as I said earlier. They also provide locals, essentially for individual people to be able to lock their stuff into it. And you've got your own cutlery, you've got your own bed, and your own linen. It's all provided to you. So it's pretty much you just come in with your bag and you are pretty much ready to live in that rooming house, do a bit of a paperwork, and you're good to stay there, essentially. Now, this is not a share accommodation. What that means is the parties that are living in this place, they're unknown to each other. It's like going into a hotel. You don't know who the guest is in the room next door. And that's exactly what this is. So the intention is that unrelated parties are living in this place. And because they're unrelated, they don't know each other. The only thing that is private to them is the room that they actually occupied. And the rental in this type of property is room by room, essentially. And that's exactly why this property, if you're going to use an existing house and turn it into a rooming house, it needs a bit of change to occur. And you also need to get license from the council to be able to operate it like a rooming house. And there are quite a few legislation items that you have to take off to make sure that it is compliant and it is checked before a license is issued to be able to run like a rooming house. It is not that difficult, but the changes are quite minor and small, but they all still need to be ticked off to meet the legislation. Now, what is the pros and cons of rooming house? So the pros are you have a higher rental yield, so multiple tenants, significantly more income because you're getting rent room by room. And that usually means that generally these gross yields are close to around 8 to 12%. Now, if you buy a standard residential property, which is let's say 500K property and the rent is say around $500 a week, then your gross yield in that is 5.2%, right? And if it is $400 a week, it's even below 5%, which means probably around 4.5%. And that's what you can probably at its max achieve this. But with a rooming house, depending on how many rooms you've got, how many lettable areas you have in the room, sorry, in the house, that's what's going to dictate how many rents you can actually get in parallel whilst those rooms are occupied. I'll show you some examples right after this, but this is where it becomes really exciting that you're not letting the whole house to one party. You are actually have multiple people who are paying you rent room by room. So therefore, the demand for such type of properties is very high in the right areas, and the location really matters, whether it's the suburb or it is to do with the actual area itself. Because what they are looking for, they're looking for people. A lot of people cannot afford to rent the whole house. A lot of people, like retirees and people who are getting old, for example, they don't want a big house anymore. They don't want a backyard. They want a small space for themselves because what they could also be single as well, or there might be even a couple who don't want anything apart from just a room. A lot of people work day in, day out, and they have no time to stay in the house. All they do is come at night, stay there, and they're pretty much gone. There could be workers who've just come in that area for a short period of time. They want to live in that house as well, and they go into that rather than doing an Airbnb, which can be quite expensive. Rather than actually paying a nightly rent, you're paying a weekly rent over there, which is still quite high for people to pay, but all you have what you have is a dedicated private room, which may not have an ensuite, but that's exactly what you get as a result of turning a property into a rooming house or building a rooming house. This also allows you to be able to boost your borrowing power because you get a strong net cash flow, which supports your better serviceability and portfolio growth. Having said that, one of the cons is that there are only very limited lenders who will even entertain a rooming house to entertain that type of income. So therefore, you have to be very creative with your broker to be able to find the right lender who actually can give you that higher borrowing capacity by actually looking at rooming house income. Most lenders don't like it. They'll take a standard rent into consideration when they're evaluating your borrowing capacity. However, it is quite good for a lot of people who are looking to just get a cash flow going. They don't want to sell this down the line. They want to keep it in their portfolio because it is a cash cow, and they have no forcible position to be able to sell something like this. Especially those who are in the late 50s or 60s would love something like that where they can actually just buy the property, do nothing, hold it. It's still residential in nature, but the actual operation is commercial. So you're actually getting commercial rent from a property like that. And that is really where things change quite positive for your cash flow position. You've certainly turned your negative gate property likely into positively geared property. So when we buy properties for our clients and we turn them into rooming houses, we obviously do the math, we do the ROI, we want to make sure it is positively geared. Otherwise, why would you even buy that? And I'll show you an example of that quite quickly. So this is also backed by government. So a lot of, in fact, all states and a lot of councils in those states are quite savvy about this. They really want to support the rooming house concept because it does help the community. It does help people who maybe low socioeconomic class or maybe people who are in that area who come and go a lot. It council wants affordable solutions for housing, and that is really also going to help people right now. Our rents are skyrocketing around the country. People are paying through their nose at the moment. So this is a very affordable solution where you are only renting a room in the entire house. So that's why I said it does have a social impact and in a positive way. Of course, there are cons that come with it. It is strictly regulated, so you need licensing, you need fire compliance. You need to make sure you've got councils to actually really approve this. Depending on what changes you've made and how big the rooming house is and what you've done to it, you might also have to allow for wheelchair access and so forth, which means you might have to widen your doors and you might have to, have a bigger bathroom and so forth. But in many cases you can get dispensation, but you really need the right consultant to help you get that, those who understand rooming houses. So we have the right network to be able to help with all that. Once we buy a property and we are converting into a rooming house, we've got the right people to be able to help with that and actually make that run like a rooming house. I'll show you some examples. Now, this is quite management intensive, so you possibly cannot manage this yourself. In fact, I do not recommend to even manage your standard residential property. If you're managing yourself, think twice. You might as well just give a small percentage for a standard rental property to do so. But management in this case means that there's a lot more involvement in a rooming house for someone who's managing this property, which means the rentals are your management percentage is going to be a lot more higher on the rental income that you're getting, and it is absolutely worth every cent. Believe me. Uh, of course, as I said, financing can be tougher. There are very limited lenders who will look at this. There are lenders, but there are very limited policies and lenders for that. And of course, you could have a lot more turnover, so there might be even a lot more higher maintenance as well on the property because there's a lot more use of the property at the same time with so many people in it. Yet all that is factored into the ROI in your return on investment before we actually look at how positive is the property. Of course, neighborhood resistance is, people might push back on actually doing something like this, but it depends on the legislation of the area. In my experience, we've never had any problems with that at all. I don't think even people have a say that you're turning things into a rooming house, at least in Victoria, and that's not an issue. Now, the floor plan that I showed you earlier is of this particular property, which is an 8-bedroom house. This is currently actually available to buy. So the current vendor wants $680,000 for a property like that. This is an older property, but turned into a rooming house, as I said earlier, on a 962 square meter block, 8-bedroom, 2-bathroom. And we actually got all the numbers of this property because this is running like a rooming house for the last 10 to 15 years already. So we got the numbers for the last financial year and this financial year all the way up to April. And based on those numbers, what we've seen is the average occupancy rate of this rooming house is close to around 84% in both the years, which is phenomenal. Which means that when you buy a property for $680,000, you need about 204,000 from your pocket, including all stamp duty or all other costs, and it's already running like a rooming house, so you don't need to make any changes. Pretty much just buy the property, and the gross income on this property after 84%, taking that into consideration the occupancy rate, is 84,669. If you see on the table on the right hand side, removing all the management fee, which is 25%, the rates, utilities, maintenance, insurance, land tax is exempt. You can get exemption on a property like this. Interest component of your loan, which is at 80% at 6% that we've calculated, you are net cash flow positive of 8,862, which is nearly 9,000. Give it as a normal rental, this property, to anyone, you are not going to achieve that type of gross rent that you're going to get. In fact, your property is at the end of the day, after all the expenses as a normal tenancy, is going to be negatively geared, which is quite expected on a property today with today's interest rate. and that's negatively geared for the year is going to be negative 8,500. So what you can see is a simple property with a simple rent and a normal way of tenanting the property would would achieve a negative result in your negative getting, which is going to be 8,500 negative. And by turning it into a rooming house, that's become nearly 9,000 positive. So it's a flip of $17,000 when it comes to cash flow. And that is phenomenal the way we see this. So that's where it gets very exciting. This is a real example of a property that our first client in FMRE, that he's nearly 60 years old and he wanted to buy a property. I'll show you, there's a video testimonial for him, which is going to run very quickly. But only for $220,000, we picked up this property, which is sitting on a 570 square meter land. It's a four-bedroom property. It was actually three, it was converted to four. We didn't do any conversions in this. There's another property which we actually got the conversions done for a client. There was a four-bedroom, and we turned it into five-bedroom, and we also added a bathroom in that other property. But this one was just running like a rooming house. Back in 2019, we picked this up. I think just about COVID, we picked the property, but the client had signed up with us, my first client of FMRE, and then we were super happy to actually find something for him who wanted a commercial, but he couldn't buy commercial. So we had to find something that can give him commercial results. And that was really phenomenal to see a 220K property yielding a net passive income of 15,000. Now, in just 2 years, because COVID had really good results, in this property saw 55% growth. It was valued over $340,000 in 24 months just from a standard growth. Has nothing to do with what's happening inside the house. The area went up, it went really crazy, and the value of the property has gone up. So he's enjoying not only the rental returns, but he's also enjoying the growth of the property as well. Let's listen to him and see what he has to say. Yeah, I think there was an audio problem, so I might just run this again. Okay, so that's exactly where the experience comes in for him. I'm not sure if the audio was on, but it is on our YouTube channel. You can go on to Find My Real Estate YouTube channel, and you'll be able to see this video there. What we are talking about is 13 to 15,000 positively get property on a 220K property that he talks about. And he's held this, when I did this testimonial with him, we've held this property for a year before he actually gave us this testimonial. So I was super happy to see that the money is just coming in. He doesn't have to worry about anything. He doesn't have to look at what's going on in the house because that's all taken care of him by the actual property management itself. And that's phenomenal result. Okay, so that is where rooming houses come to an end. We will be doing webinars down the line that will talk a lot more detail about the rooming house and how what are the things to really look at. But for today, we're just introducing some of the strategies that we have implemented and seen results, and that's been an incredible results for clients to actually hold the right property for themselves. So talking about the next strategy, which is short stay. Now, this is not uncommon. A lot of people know about short stay, which is Airbnb, very commonly known. And that is a short term rental, essentially. But a lot of people worry about should I really put my property on, Airbnb. I don't know if I'm actually going to get income. And a lot of people are worried about, like, maybe it's okay to do standard rental. Why take the headache and take the risk? What if it actually doesn't rent out? And if I make all those changes and turn my property into Airbnb, maybe I'm not getting enough income, and people have a lot of fear to that. The point is that yes, not every property is rentable to Airbnb. It needs to be done the right way, and therefore it is a cash cow strategy. You can actually make a lot of cash coming through the door if you are in the right area, or at least have your property presented the right way, and you can improve the outlook of the property, so it is more attractive to guests who are looking that online to be able to rent your property. It can happen anyway, but to actually grow the chances of it to rent the right way, you need to do the right analysis to make sure you buy the right property in the right area for you to achieve a very high occupancy rate in that area for Airbnb. And in most cases, we've seen that in lifestyle locations, CBDs, or areas with strong tourism, or even where you can actually see a lot of business centers, a lot of people who are moving in and out of that area. We see a lot of people using Airbnb as an option or short stay. There are many tools now and platforms that are now encouraging for them to host their properties on their platform. And believe it or not, there are areas where are doing very well on booking.com versus actually Airbnb itself. You would probably think, okay, Airbnb is the leader. It is worldwide leader. However, it depends on the use of platform, per country. And in one of the areas in South Australia, I know somebody I was talking to the other day, and he's a developer. He has his own Airbnb property for way too long, and he said, I actually get better returns on my Airbnb. I get more bookings on booking.com than actually through Airbnb for some reason. And that's phenomenal. So, really, this is about trying which is the right platform. And therefore, it can be a nightmare if you want to manage this yourself. The best way to do this is to actually have the right property manager or an Airbnb management company who can actually short stay management companies. There are many short stay management companies who specialize in this space, and all they do is manage your bookings, manage the guest communications, whether it's something's broken at late night, whatever happens, something goes wrong with the property, something there's a break in or whatever is going on, cleaning. They take care of everything for you essentially. So all you have to worry about is the money coming in, when is the booking happening, what's going on, and you're pretty much just looking at it as a calendar being booked, and you can see that. But all the management part is being handled by somebody else. Of course, that actually means that they take a little bit bigger share of your rental that's coming through, but it's all well worth it. So talking about that, we're talking about standard lease duration could be 1 night to 90 days in short stay versus 6 to 12 months, which is a standard rental. You need to have a property fully furnished and make it more comfortable. The more cozy, the comfortable it looks on the good photos. Don't try take your own photos. Make sure that you actually get a professional to take the photos. If your property doesn't have good furniture to stage the property so it actually looks really good. But make sure you have same or similar type of furniture there, because that's the expectation. Your guests are booking that place because they are looking at what they can expect, and you need to make sure it looks alike that way. But in order to make sure that you are able to um, you're able to attract that type of a guest, your photos, the lighting has to be really good. So use professional photography. I always recommend that. The house doesn't have to look luxurious, but it has to look very comfortable and cozy, and it has to look at your competition, what they're putting in that particular area, and just make sure that it looks a little bit different, stands out, and that's what really people are looking for. So these guests are transient in nature. So a lot of people can complain. You know, if something is not good, you don't want to handle those complaints. You really want to have your property manager do that for you. So high potential for income, but at the same time, what is going to increase your chances of the right income is when you buy in the right area and you do it the right way. Of course, there is regulation and it is pretty strict. It depends on the country and, of course, the area and the state, but it is quite well, embraced by obviously all the countries. And Airbnb is doing really well in Australia as well. Okay, so we've talked about high rental income. That's your pros. Usage is quite flexible. So if you, let's say you own an investment property for a lifestyle in on a beach somewhere, in Queensland, and you live in Victoria. Now you want to go there yourself. So you can block out the dates. You can still use the property for yourself, which doesn't happen when you have a standard rental in that property. So, and once you're done with it, you can put it back on it and it's live again, for people to book. So you can actually live in that same property as well for a few days if you really want to, or if you want to be there for 6 months, you can, but you have the choice to do so. It's a lower wear and tear because the people who are coming in there usually are not holding big, large parties. They're people who are there to, as tourists coming there, living there, showing, most of the day they're out anyway. But, we've not seen a lot of those things happen. Yes, there are always outliers to situations like that, depending where the property is at. If it is obviously going to attract youngsters to live there and that's where the place is, then that could be the case. But depending on where your property is, you will attract a similar type of tourists as well. Dynamic, your pricing advantage of you have the ability to adjust the rates for events, holidays, peak seasons. So this is where even your rental management, company can really help because they really know the peak seasons when what is happening, and they can make adjustments accordingly rather than you have to worry about that. And they can make suggestions that what you should be really putting out there based on the data that they have. Tax deductions and depreciations. Yes, if it's a new property and whatever, obviously this is treated like a business. So you should talk to an accountant of how you can actually get those benefits. But it is absolutely well worth doing something like that. So cash flow is good, as I already mentioned. The cons of Airbnb or short stay is high management effort. So we already talked about that because they're quite constantly in touch with the guests. They're coordinating everything. They're coordinating cleaning for you. They're obviously chasing reviews. It depends on how active they are, but that's what they should really be doing, and just ensure that a guest has a great experience whilst they stay there, right from actually booking to all the way up to when they have actually exited. So you want to make sure that you choose a right property manager who is really keen and proactive in what they do and also very pleasing in communication. So the income can be volatile. That is also the cons. As I said, of course, depending where it is, your occupancy rates will dictate what you can earn. Of course, there's no silver bullet to that, but you can go by the average of what is happening in the last 2 or 3 years in the area, and then you can probably know your occupancy rate. There are tools that actually tells you about that. You can actually find out what does the occupancy rate looks like in the area, and even for your own property as well. There's a tool called ADNA, and you can check a lot about that. What are the statistics and how Airbnb or short stay looks like for that particular area. High operating costs, so cleaning, finishing, utilities, internet, insurance, and so forth, platform fees, they all have to be added up. So we take that into consideration when we're building a return on investment for our clients, and that's taken care of. So I'll show you examples as well. And of course, I mean, um, if you're doing this for the reason of income for yourself, treat this like a business because this is a business, right? This is an asset which is really giving you the return that you're looking for. People who can't buy commercial, people may not like rooming houses. This is very standard stuff. There's no change in classification as such in the property. It's a standard property. Yes, if the more renovated it is, the better the appeal is. Like we've just literally just bought this property. It is currently under contract. We haven't settled this yet, but we will be, and as soon as that happens, this property will get furnished. Right now, it is staged because it is selling. We are even trying to see if we can, keep that furniture. But if we can't, then of course the buyer will have to furnish the property, and pretty much just as simple as what you can see right now in the photos. It looks really nice. It's a very old house, but it's fully renovated. So that's really beautiful. And it's in one of the top 1% Airbnb area. So location really, really matters. And for a property like that, which is costed us, the purchase price is 625,000 on a 841 square meters, 3 bedroom, 2 bathroom. The gross income is 73,628 from this based on the calculation. And this is estimated based on a property that is being rented or running like a rooming house. Sorry, rooming house. It is running like an Airbnb, for some time. And we took the latest numbers of that property, which is running like an Airbnb, and it's very close to this property. And based on that, we've done numbers on this property, and we believe that they can achieve a gross income of 73,000 conservatively. So it's the average daily nightly rate is around $290, pretty much, right? And that's a great return. The other property is achieving probably 315, 320, but we've taken that because it looks probably more nicer. So we've taken 290 for this one. And we've done some calculations based on 84%, 70% occupancy. And you can see that 73,000 is taken into consideration as gross income. Management is 22%. There are other direct costs of 10%, which is platform cost that I mentioned earlier. Rates, utilities, maintenance, insurance, land tax, and interest is also deducted. So you have 9,500 positive as opposed to a standard property with a standard rental being 10,200 negative. So it's a comparison that you can see there is a flip over of nearly 20,000 in cash flow position, which means this can really, really boost your income position. And also there are now more lenders who entertain Airbnb income as long as it's been running for a while. So they obviously need to prove that. As I said, it's a business. So when you show this as a business, they will take that into consideration. You need to talk to your broker or a banker in the right way just to make sure that how much they will they will consider as an income coming from Airbnb, and it also depends on the history as well of that particular property. But at least there are more lenders looking at this as an Airbnb. They will consider as a borrowing capacity. It really helps you boost that. Also reduces your negative position as well. So if you have a portfolio where maybe you've got a couple of properties that are quite negatively geared, adding properties like this can actually help you balance your cash flow as well. And as interest rates are coming down, those negative geared properties will also start to get better in negative position. Maybe some of them might even turn positive. I'm not sure, depending on your situation. But properties like this are absolutely cash cow from the very first get go. And we've done the numbers on 6% interest rate on this property as well. This is that property which is already running like a Airbnb nearby, and we've got the data for January, February, March, April, and then we looked at the number of nights that it's actually been rented out. We've done all the calculations, and based on this property, which is already achieving a net cash flow of $11,000 on a $318 per night, which is running nearby, we're very confident that when we've taken the numbers on 290, this will work on the same average occupancy rate of 70%, right? So it's driven by conviction and it's driven by data. And that's exactly when you're in a top growth market in top Airbnb rental across the country, you cannot go wrong. And moreover, the property that we actually purchased, you can actually see that across the road, somebody has demolished and actually built 3 units as well there, right? And it's side by side. Down the line, if really want this to happen, you can demolish this and build 3 units here as well, and maybe put all three of them under Airbnb if you want, right? So that's really how you can actually be very creative and multiply your incomes as well if you are actually going to stack up your strategies, essentially. Okay, moving on to the next one, we are now at commercial. Now, this is amazing because commercial is quite standard. We understand commercial that way, that there are commercial properties, and right from retail, office, industrial, mixed use to specialist type of properties being childcare, medical centers, service stations, cafes, shops, strip of malls. You've got shopping centers, corporate offices, co-working spaces, medical suites, warehouses, factories. I mean, name it, they're all under the commercial banner essentially, although they have the different categories as I just mentioned. Now, what this really does is similar to what I showed you in the other two. They're high yields, right? But they're high net yields. What that means is that, so let's take an example of rooming. We talked about 8 to 12% gross yield, right? Airbnb is also gross income that you're getting. and then you're deducting all the expenses from your pocket before you see the net number. In this, we are saying in the commercial terms, let's say there is a rent of $100,000 that's coming to you on a $1 million property. So that $100,000 is a net rent, is not gross rent. In most cases, it is a net rent plus GST plus outgoings. Outgoings are paid by the tenant, who's the business itself. So that 100K is now net already, which means most likely all the rates, maybe if there is any building strata, if there is any maintenance, all of that is tenant's problem. Of course, every lease is different in commercial as well, and there's no standard way of what should happen, but it is quite common understanding that majority of all outgoings are going to be paid by tenant. The outgoings that usually as a buyer that you pay or as an owner is maybe property management and sometimes building insurance as well, right? And land tax could be yours as well. But other than that, everything else is tenants. And of course, with that means that the only number on the 100K that you have to minus is going to be the interest component of your loan. And that is really going to be your net position on your cash flow. And this is why this is amazing. Right now, most people don't enter commercial because they don't know much about commercial. They have the fear, they have a stigma that commercial properties don't grow in value. That is not true. Commercial properties can grow enormously if things change overnight in commercial. What I'm trying to say there is that if let's say that 100K um, income that we were getting, the net income from the property on a $1 million property, that means let's say if tomorrow the income, if my rent goes up to 120 instead of $100,000, let's say that happens after 2 years, right? What I've just done is I've actually changed the value of the property as soon as the rent goes up. So we bought the property with 10% yield, which that is basically the cap rate of 10%. And if I keep the same cap rate, and because it's become 120,000 and I divide by 10%, my actual value of the property has gone from 1 million to 1.2 million. So it's an increase of $200,000. So just by shifting $20,000 in rent, my growth is $200,000. Now, this can happen in 6 months, in 3 months, in 2 months, or it can even take 3 years, depending on when that rent is changing. The other factor is if the risk on the property reduces. So let's say rather than giving to one tenant, which is getting me the 100,000 rent, I actually split that up and I give it to two tenants. Now I split that property up and I can give maybe half to tenant one, half to tenant two, and I'm getting the same $100,000 rent because the risk is lower now, right? That can actually improve my value of my property overnight as well. That's how valuations happen. So it is not based on emotions. It is number driven game. And a lot of people ask, oh, this property only, was sold 2 years ago. How has it gone up 60% in value? That's not possible. Yes, but you're still thinking in residential terms. Commercial doesn't work like that. It's a number game. And it is not land dependent either. It's not that if you have 1,000 square meter block and you have a commercial on 300 square meter block, it's 1,000 that's going to grow more than the 300 square meters. It doesn't work like that either. So it's all to do with the lease, and it's all to do with the income of that lease. That's really where your actual value of your commercial lies, right? And I'll show you some examples. But it is absolutely amazing. Once you buy commercial, right, and you get used to buying commercial, most people I've seen don't go back to residential because they're so used to the cash flow position that they want. And you tend to have the tenants on a longer term as opposed to 1 year and renewal. Usually, in a good area, people will go 2 plus 2 plus 2, which means the lease is 2 years plus 2 years plus 2 years. So you're at least there for 2 years. It could be 5 years, it could be 3 years, it may be 1 year, or it may be that lease is expired and they want to do a new lease. So you might be able to negotiate the lease and its terms and the outgoings. So let's say we are actually buying a property right now where all the outgoings are paid by the owner, because in COVID, owner was paying all the outgoings. The tenant is actually on month on a periodic lease. We are now negotiating that whilst we will give the price far lower than what they're asking based on the numbers we know. It's not emotion based, it is numbers based. So we will be buying the property at much lower price point that they're asking. But we are also negotiating that it is not, the owner is not going to pay the outgoings. The outgoings will be paid by the tenant. and they will sign a new lease, which is at least going to be 3 plus 3 plus 3, and that gives a lot of confidence. By the way, the tenant is in the property for the last 15 years already, and they're happy to stay there. And what we know is they're also happy to sign the lease, and they're happy to pay the outgoing as well. So this is all about negotiation, really understanding commercial, and really going back. There's no emotions here, either from the vendor or from the buyer. It's a number-driven game. That's how simple it is. Yes, there are risks depending on where you end up buying what you buy. You have to be really careful with that, but it's an absolute cash cow, right? And I'll show you some of the examples, but before we just talk about pros and cons. So higher rental yields, longer lease term, as I said, tenant based the outgoings. It is value based on rental income. And that's why I said lease is everything. If you have a great strong lease, if it's a national tenant, you're anyway increasing the value of your property. Let's say I give you an example of splitting the property into two tenants. But there's also possibility that you have a very local tenant over there. It's a clothing shop, and let's say that clothing shop leaves, and now you actually bring a national tenant in that place. So let's say there is now a national tenant clothing shop over there, let's say for example sportscraft, so the value changes of the property, because now what's happened is risk is reduced because now you have a national tenant there, right? And that increases the value of the property as well. So it's not always to do with the rent. It could be rent and or even the risk as well. Less emotions, more numbers. That's how it is. And the cons is higher entry costs. So of course you might not be able to borrow as much, depending on 50% to 70%. That's really the cons part of it. But we've been buying properties, retail style of properties, nearly between anything from 70 to 90%, sorry, 80%. And in most cases, 75% is sort of the average number we are seeing. But if you end up buying an office space, you end up buying a car a car space, then you're not going to get that. Or even for that matter, storages are doing really well, but you're not going to get more than 50-60% on storages either. So so when we are trying to pick up a type of commercial, we want to make sure that people can borrow as much as possible, and at the same time balance the risk appetite as well. Longer vacancy periods can also happen. So if the tenant leaves, yes, your properties may stay longer on the market before a tenant would take that over. But that's where location matters, and you can manage the risk accordingly. Or you have multi-tenancy properties, so you have multiple tenants in the same property. That can also help. And I'll show you an example of one property which has 5 tenants in the property. But that's where your risk can be managed that way. And of course it is susceptible to market sensitivity as well. So economic cycles, of course, how the businesses are doing in general. Now we had a lot of high interest rates, a lot of people had trouble holding their rents, and during COVID as well, we knew commercial was not doing very well because there weren't any people going into commercial properties. So yes, these challenges can happen, but that's where the risk appetite comes in. Not for everyone to start with, but most people say, okay, can my first property be commercial? I mean, nothing's stopping you financially. Are you mentally ready? Do you have the risk appetite to do that? If you understand your risk appetite and you understand what are the risks, that's really your call. But there's no right or wrong, whether it's your first, second, third, fourth, doesn't matter. At some point in time, you're going to have commercial, if you have to retire right in the right way, or commercial like properties like Airbnb, rooming houses that I showed you, because those are sort of not of the ordinary. Most people may have one in their entire portfolio, but you can actually look at that as optional. A lot of people are building rooming houses now, so and Airbnb is very, very common, so you can do that. All right, so now let's look at some examples. Now we bought this medical center in South Australia for $470,000. Yes, medical center for $470,000. That's absolutely insane. The purchase price is 455. They were asked for 470. The net rental is 40,838. Now that's net, which means that's what I'm getting in my hand plus GST plus outgoings. So my net yield, this is not gross yield, my net yield is 8.9% and 75% loan to value ratio, right? So the cash required for this property to buy was 145K. So my net cash flow after my interest component is $15,000 on a property which is leased up to November 25, which is end of this year. This was purchased last year, so we had 1 year plus there's options. So hopefully this medical center, whoever is in it, they will extend the lease essentially because they have the options. And the land size is 405, but it doesn't really matter. In South Australia, commercial has no stamp duty. That's amazing. So there's definitely options to do that there. In Victoria, it's 50% benefit of stamp duty. So it's a high growth area, and that's what it is. Now, this is a property in Queensland that we purchased for 900K, asking for 950. The net rent is 79,490 plus GST plus outgoing. So the net yield is 8.8%. That's amazing. And we needed 287,000 to buy this at a 75% LVR. And the net cash flow is $30,000 after the interest component as well. So five tenants. There's a cafe. There's a retail shop at the bottom. There are two residential units on the top, and there's one studio at the back as well of that entire building. Now, the building itself is on a 300 square meter corner block, which is not much of land, but it does phenomenally well when rents go up. So this rent of 79,490 was 75,000 at the time of purchase. Just by changing $4,000 in rent, this has changed the value overnight by 40 to $50,000 on that property already. That's how actually growth works on a property like that. And that is a thriving area. The location is phenomenal and it's doing quite well at this stage. So if you have a property like this, what this means is that if your net rent in today's dollars is $79,000 and that net cash flow is 30,000, that's positively geared property for you from very get go. And if you don't have any loan on this one, you're getting $79,000 absolute clear cash in your hand after all property management costs and everything else. So which means that it's phenomenal. Buy two of these, you've got your 150K passive income. That's how it really works. We will talk a lot more about commercial in the next session when we have on the 19th of June. And we do plan to actually run this a little bit with more details. So I just thought I'll touch it on today with the introduction. And on 19th of June, you already registered those who are on this call. You will receive a reminder again on 19th of June to jump back on this one. And we will cover commercial a little bit more in detail with these examples. And I'll show you calculations as well and some of the basics that we're going to cover on that day as well. So with that, what we are now open to is Q&A. If you have any questions, I know I went a little bit fast. I had to cover the things in an hour, which I've tried to achieve. We had a bit of a technical issue. So I hope I've not taken too much of your time and you've been able to understand what I was trying to say. Now, we do have a Isle of Property Facebook group as well. We have close to around 3,000 people, members in that group. You're most welcome to join this, take a photo, later on scan and get onto Facebook or go to facebook.com/groups/grow my portfolio, and you'll be able to join this group as well. You can ask all your questions there as well. And there are plenty of professionals who can answer your questions there, right from brokers, accountants, lawyers to building inspectors, whoever you want anything to do with property industry related people, they're all there on that group and you'll get your questions answered. I'm quite active, so if you ask me questions, we'll be able to answer questions there for you as well. All right, so for now, if there are any questions, I'm happy to take them, else we can call it a night and we can all go. Okay, any questions? Anyone's got any questions? Okay, probably no questions so far. Just okay, no problem. Okay, all right. Maybe I was really good at explaining. So I think um, we are pretty much done with our session. Thank you so much for those who came tonight. I really appreciate your time and can't wait to see you on the next one on the 19th of June. And hopefully, you are quite excited to see more on commercial, but get things moving because this is your right time to move and do things the right way for yourself. Thank you so much for coming tonight and see you soon. Thank you very much.